So Wolf was talking about the GDP number at 2.6%. Pretty strong growth. How did that meet your expectations?
I think it's in line. I mean, it was a little stronger than expected, but the key question is what's the first quarter going to look like? Because we had some questions about consumer spending. Got that very weak retail sales, but that does not match up with a lot of other data that you've seen on the consumers. So I think, in the first quarter for the last few years has been a weak quarter. There seems to be some sort of seasonal adjustment problem in the first quarter.
Right.
It has led to weak first quarters for several years.
Do you believe that there's a possibility of having an upward shift in potential growth here? That's something the administration has really been banking on. They've penciled in 3% for the next several years as part of their forecast for the tax cuts. What's the possibility of shifting upward our 2% growth potential?
Well, there's obviously always a possibility. I mean, productivity growth is very hard to forecast, and if productivity growth picked up, you could grow at a faster pace. I think the problem is that we haven't really seen the kind of investment response to the corporate tax cuts that would be consistent with a significant acceleration in productivity growth. So I'd be betting against it.
The Federal Reserve just recently did a pretty dramatic, I'd say historic pivot. It was going to hike several times this year, and now it's saying it's patient. It went from gradual increases to patient. It's going to be ending the balance sheet reduction this year. What do you make of this pivot they made? And is it consonant? Is it congruent with what they're seeing in the economy?
I think they've said for time immemorial that they're data dependent. And I think what happened was a pretty significant set of information changed. Number one, financial conditions tightened in the fourth quarter quite significantly. Number two, despite strong payroll growth, the unemployment rate stopped declining. Number three, the tightness of the labor market didn't lead to much wage acceleration. And number four, inflation was a little on the soft side. And number five, there are real questions about global growth, China, Europe. So I think all those things, none of those things by themselves would have been consequential, but collectively, I think that changed their view of the downside risk to the economy. So with inflation, not being a problem, I think they decided, why not just wait for more information. Doesn't mean they're done.
Yeah.
It just means they want to see more information.
How seriously do you evaluate these risks, for example, from global economic weakness?
Well, I think there's been a lot of news out that suggests the global economy is weak. Now, what's happening is we're seeing responses. So China, for example, is really now pushing out the credit again.
Right.
So I think that there was weakness. We're seeing a policy response. So I am not of the view that U.S. is likely to have a recession anytime soon.
One of the things that you were involved with was you actually managed the decline of the balance sheet. What about this idea that the runoff's going to end later this year? It's going to be something like a $3.7 or $3.8 trillion balance sheet. Is that bigger than you thought?
I think it's bigger than most people were expecting, but I don't think it means that much. People are very focused on, they're stopping earlier, therefore somehow they're being easier. That's not what's really actually happening. All they're doing is finding out that the bank demand for reserves was bigger than they thought. They want to stop the amount of reserves in the system to have a buffer over what banks demand. Originally, people were thinking the bank demand was here, so they could stop down here. Now they're finding the bank demand is up here, so they have to stop a little earlier.
You were the guy who was selling off the balance sheet, so you're at fault, according to a lot of people.
We weren't selling. We were
allowing it to run off. Sorry, technical change there. What do you make of the problems that people associate? They said it caused the stock market to decline. It caused the economy to weaken. Was the balance sheet at fault?
I think that's definitely not the case. Look what's happened. The balance sheet is still running off, and the stock market's recovered in the first quarter. So I think the balance sheet, it was a convenient whipping boy. The Fed's seeming, inflexibility in the space of all these market developments for a while was a convenient whipping boy. But, the markets occasionally go down for a whole host of reasons. I think what happened was markets were responding to the increase in risk about growth in the rest of the world. And they were going down the stock market was probably wrestling with much weaker earnings growth.
I'm sorry, to the control room, I've got one more question, which is because you raised a good one. This idea of the market went down and the Fed responded. Does it look like the Fed was too responsive to the market? And that there's a big put out there from the Federal Reserve?
The Fed does not care about the level of the stock market for its own sake. It does care about the sense that if the markets really tighten, that will have consequences for the real economy. They have to take that into account. So, the stock market goes down a little bit, I don't think the Fed cares at all. If the stock market goes down a lot and that starts to affect the economic outlook, of course they care.